We are very excited to have you, and thank you for joining us wherever you are in the country. Good morning, good afternoon, and thanks very much for taking time out to join us for this webinar. We're going to do a couple of things. We're going to talk a little bit about the mid-market opportunity, why we think that's right for the picking, and then how we've created a solution that allows you guys to really take advantage of that market space. Paul's going to then jump into best-in-class mid-market partners that are servicing the mid-market and what their trajectory is and where they're headed. And then we're going to talk a little bit more about the mid-market customer opportunity, what that looks like, how you can leverage mid-market business continuity to become more services-led. Paul's going to spend some time on that. And then we'll do some Q&A. We'll get to have a live conversation with both Paul and Junior, and we're very excited to have you. So thanks again for joining. So I love it when we get to have guests with us. Today we have Paul Dipple, who is the CEO of Service Leadership. You may be familiar with him. He is an exciting guest to have on the broadcast. Thanks for joining us, Paul. I really appreciate it. And we also have Junior Silva, our product manager at StorageCraft, who has been primarily responsible for helping us bring an exciting solution to the marketplace that helps partners really take hold of this mid-market exploding opportunity and really open up your addressable market. I'm Janine Edwards. I work at StorageCraft as a Senior Director of Channel Marketing. I love partners, so let's get to it. Super excited to have the conversation start.
Since I actually control the slide deck, I have to take a moment to say this actually isn't a picture. This is Paul. This is actually not a picture of me. This is my dad. And I really look a lot like, much more like Junior's picture in real life.
Yeah, Junior has Junior is apparently a Los Angeles actor in addition to being a product manager. So a little bit about StorageCraft. For those of you who aren't yet familiar with us, a quick introduction. We're a data management and recovery company founded in 2003. We were first out of the gate with backup technology and are known for innovation in that space. And most importantly, we're a channel-first company from our top down. Channels in our DNA, our president, our CEO, down through our leadership team, we're 100% committed to our channel partners. And over the course of the past 12 to 18 months, we did have an opportunity to make a huge investment in our technology and our innovation across our solution set. And that's what kind of brings us here today. And you can switch to the next slide. Because we're a channel-first company, we're very committed to looking for ways to help our partners grow their business. And when we take a look at sort of what the opportunity is right now, there's a real ability to open up the available market. And we believe that the mid-market is super ripe for the picking. We have had our eye on the mid-market, and we think you should too. And here's why. Because it's currently an underserved market that's desperately in need of outsourcing. These guys are in expansion mode. They've come to realize that digital transformation is an important, huge variable in their growth, right? They're looking to sort of unlock growth, and that means they're also looking to unlock spending. And there's sort of this huge shift happening in that segment of the market to utilize technology to fuel that growth, as well as gain competitive differentiation. If you take a look at these stats on the right-hand side, there's some interesting things to take a look here. 69, almost 70% expect revenues to increase, right? But 55%, almost half or over half, are still looking to reduce operational costs. And over 3/4 see business complexity as an impediment to growth. So when I take a look at that, all that equals to me is that there's an outsourcing opportunity for channel partners. And you can pop to the next slide. So let's dive a little bit deeper into that, right? So we've got explosive data growth happening, right, as they take a look at how they can move more into digital transformation and grow their business. And that leads to intense management complexity. And this segment is also becoming more susceptible to data loss with ransomware, et cetera. But they've also got staffing restraints. So they've got enterprise level challenges all the way around, but they've got mid-market limitations. So Gartner tells us by 2021, 40% of mid-market IT teams will be considered versatilist. That means they're being focused on the run of business and they can't specialize or be SMEs in specific things like the things that are impeding their growth. And that means that you guys enter, right? So go ahead, Paul.
That sounds like jack of all trades, master of none, which means they need solution provider help.
Right. Enter you. So the SDC team the StorageCraft team has been super focused on innovation over the course of the last 12 to 18 months. And we've been very focused on bringing the partner community a suite of products that not only spans the entire business continuity, but helps you, again, address and increase, your available market. And we want to empower partners to take advantage of this sort of right for the picking segment of the market. And we're doing that with our most recent innovation, OneSafe, all the way to the right here, you see it. And OneSafe is what we consider a data management game changer. You can pop on through. And when we were taking this out to market in beta and sharing it with the partner community and analysts, the IDC folks really were interested in what we were doing. And right here you can see that our OneSafe aims to shift the paradigm of traditional data protection by converging data platforms. It's a development worth watching closely. So we wanted to, again, connect the dots between the available market and what we're doing. And what we'd like to do now is really spend just a few minutes giving a high-level view of the solution that we've created that empowers partners to bring this right fit solution to this particular segment with very specific needs around their growth goals, in addition to the challenges that are presented to them for these growth goals. So Junior, who I'm always excited to have with us, is going to spend some time highlighting this feature set and connecting the dots on what that means to you as a partner organization that would be adopting a solution like this, and to your current and future mid-market customers. So go for it, Junior.
Thanks, Janine. We're really excited to bring you guys this solution. As we interviewed, hundreds of partners and end users, just trying to understand the needs of that mid-market, it always comes back to, it's too many moving parts, too complex. We're trying to manage all these different systems, and they would always come back to, can we simplify getting these 3-4 different systems into a single system that we can easily manage? So a lot of time was spent on understanding their needs for data growth. We would ask partners, when was the last time that you accurately predicted the capacity planning for an end user? And we always get like shaking heads, because they predict, in 3 years you're going to do this, and then a year later there's a capacity growth need. So we wanted to build out in a model that it's really easy to just add more storage, right? That you can scale out. You don't have to be stuck to the same forklift upgrades and things like that. And so with our OneSafe technology, you have a distributed scale-out file system. You can have performance. There's SSD, hard drives. It's an object storage, so inline dedupe, compression. So all of the high-level features that you want to in a scale-out storage, encryption at rest, replication, all of that, when optimized replication, all of coming into a single platform. Integrating with that, we're best in class. StorageCraft has been data protection on its DNA for many years. We've traditionally had an agent-based protection, and we've been king in the agent physical machine recovery space. And we've moved over also into the virtualized environment. So using VMware APIs to do host-based level type of protection. Bringing all of that into a single, easy-to-use manager interface, and having our purpose-built DR as a service cloud that you can provide services with as well. So with our cloud, it's made for DR. It's not archival and things like that. We say, hey, it's cheapest, Amazon, Azure, go there, Google. But in the scenarios that you have mission-critical VMs or machines that you need to spin them up in minutes and with a single button, single-click failover, spin it up in our cloud and then fail back to your environment. So that whole fabric is all into a single. So we're we're pulling together all these different components and simplifying it into a simple offering. Next slide. And what you can see with this offering, kind of some of the, depending on who you need to serve, they may have a couple different use cases. So one of them, it may be, I need storage. I just need storage. I have already my data protection and things moving. It's like, if that's all you need, well, we can serve that. We have a couple different models, the middle two models, the 4412 and 4417. These are capacity-based models. And then we also have an all-flash unit, and that's the 5410. So all of these, you know, if they need storage, you can start with a piece of storage. If they need data protection as well, or in the future, you can roll in data protection that's already included with the appliance. If you need just data protection, you know what, I have a lot of storage, I need to get my ROI out of it. So you can start with our virtual appliance with Shadow Safe, and then at a later point, if you want to integrate and get more efficiencies and simplified licensing and management, you can bring on the storage with it to make that converged data protection unit. All of these can be used with our DR as a Service cloud. And so you can build out a seamless infrastructure, putting together 4 different components in a data protection world into a single solution that's easy to manage. So people ask, where does this sit compared to some of the other technologies in the industry? Where it sits on pricing, you see, it's comparable to like a Rubrik or Cohesity solution, but at about half of the price. So that's kind of where the pricing sits, but it has feature sets that is a scale out. So a lot of solutions, they don't have, you have to forklift, or it's a lot of money to upgrade from, if you underspec the sizing for the environment, the sizing of the data protection, you're going to have to forklift and drop a whole new appliance. With ours, it's a simplified pricing and licensing, and you get all the high-level feature set, but very easy to scale. So that's where it kind of sits in the middle of so above all the traditional BDR, backup appliances, storage, and similar feature set to a Rubrik or Cohesity, but about half the price. So just to kind of show you what it looks like, I'll pick, these are just entry-level units. These are all MSRP, so you can see what it's actually used. And you have the raw terabyte usage on the capacity, but also the usable capacity, how much you're paying. So you're going to have about half of the price for an entry-level competitive offering. So if I get a OneSafe 4412 over there, and it's going to be 2x the usable storage, so a lot more value. And then you'll also get OneSafe. Every license, it comes with premium support, and it comes with a 4-hour on-site hardware support from Dell. These are built on Dell chassis, so you get 4-hour on-site. So we know that these are mission critical. Your business is mission critical, and we want to keep that up. So a lot of some other offerings, they do a next business day or things like that. With the OneSafe solution, you're already having a 4-hour on-site for hardware support for you. So 4x value, half the price, 2x the available storage. Next slide. We really wanted to make this in a simplified, make it radically simple, easy to use. So you can have a lot of managed services. You can manage a lot of endpoints. Everything is in a very intuitive UI. We spend a lot of time going over the workflows and how much you're going to be able to, how many clicks you're going to be able to do that. And hopefully I'll show you that. And so what that means is just, it's simple, so lower complexity, easier to implement, and easier to manage. So that's better ROI for you guys. everything is in our, as we were managing, we interviewing people, they're like, there's a couple things that I do all the time. And so SLA protection is one of those. So we wanted to make it very simple. So you have everything, the full data protection lifecycle is in a single screen. So very easy to manage. You set your RPO, set your target, retention, replication, and then hit go. If you wanted to tweak something from, let's say, a mission critical machine, you have 2 clicks, clone, change the setting, save. Everything that we've done, we interviewed a lot with VMware as well, and it can't be more than 7 clicks, and so you'll be able to see this. But easier to manage, easier to use, and you can see the value right up front. So again, just a little quick overview. So you have data protection, you have host-based and agent-based data protection. You have the ability to virtualize these machines in milliseconds. This is a technology that we won Best of VMworld a few years ago, and we've improved and made it even better. So you're able to, even if the machine is sitting in a cloud on our DR as a service cloud, we're able to instantiate that machine on-prem at milliseconds. It's really cool. It's really fun to show this. I have to actually go into vCenter and show this is where the machine is going to show up, because as soon as I click go, it creates. And it takes longer for the VMware APIs to create the machine and turn it on than it does for actually our restore to go. So it's really fun. SLA oriented protection. This is, again, simple, unified, easy to use. You want the machine to do certain things, whether it's agent or agentless, it's completely integrated, and there's no difference, physical machines or virtual machines. And bringing all of that into with business continuity, if things go wrong on-prem and you're not able to spin up, or a whole site goes down, you're able to leverage a one-click failover into our cloud, so you can have everything restored to the same point. So this is a final comparison, just so you guys can see. Number of clicks, to give you an idea. So the whole deployment and data protection, you're done with 34 clicks. And a comparison we did, just a quick little bake-off, it was with Veeam 9.5. You're 140 clicks later. Deployment of the solution, we're under 5 minutes. So that's how fast you can deploy, and you can build your professional services on top of that. You don't have to charge 1/10 of the price, but you're going to be extremely competitive and have really great gross margins as you deploy something like this. So full data protection, and you already have a first full backup in 10 minutes. Number of clicks, you'll see over here, you guys can see about recovery, 4 clicks. So you don't have to think about, when you go to like 22 clicks or things like that, you have to think about every step of the way. And you're like, what if I got wrong? Well, we built a lot of automation. So a lot of those things are already in the heuristics of it, are already all built in, because we know we're experts in this industry. We've been here for 10 years more. We know what we need to do. And so we made it very simple for a user to go through these restores. A couple of our customers, sometimes they say, why do we choose OneSafe and data protection? Very easy, better economics, incredibly easy to use, and great support. So we're excited to have this offering, and excited to share with you guys some of the benefits outside of the product. We have great product, but also some of the channel and some ROI and things for your business.
Thanks, Junior. Thanks for giving us a sneak peek on how we've brought the solution to the market that's going to really help partners take advantage of the mid-market. Now we're going to switch gears, throw it over to Paul, who's going to share some awesome data regarding best in class with mid-market partners.
Thanks, Janine. I wanted to underscore a couple things that I caught from Junior's presentation. As most of you on the call know, we talk about how to do value-based pricing instead of price. value-based selling instead of price-based selling, because value-based selling earns you higher margins and differentiation and so on. It is harder. No question, price-based selling is easier. Not easy, but easier. My takeaway from Junior's presentation was 2 times the storage at half the price with the same or better capability. So, the same or better capability means better value, and that makes value-based selling easier. But twice the storage at half the price means you can also use price-based selling with these guys, and that's pretty much the best combination you can get on the planet. This is to be able to come in at a lower price and show higher value. So that's pretty cool. The second thing I noted is in the ease of use, the radically simple management. It benefits the client if the client's doing their own managed services, but if you're doing the managed services around this, that ease of use benefits you. And it's cool to see that StorageCraft has recognized that in their product design. And the other thing that Junior touched on is the incredibly faster time to deploy. As he pointed out, the great benefit of that isn't that you would charge the client 8 times less for the pro services. It's that it takes your people 8 times less to do the implementation, but you can drive up higher service margins by only charging the client half as much for the project instead of 8 times less. Clever trick. And then you noticed in terms of the number of clicks and the time it took to do a restore, that's on your managed service team, right? And so you're charging a flat fee to manage their environment. And if your team needs to do a recover and restore or a failover, wildly fewer clicks to do that in comparison to the folks that these guys are usually compared to. What does that mean in a managed service environment? Well, it means restoring the customer more quickly, but more importantly than that, 4 clicks, 4 decisions versus 22 clicks, 22 decisions means the restore is most likely to occur correctly, and it could be carried out by a less skilled person. Less decisions, less skill needed, lower cost people to do the same job. So these guys have really thought through your pro services model and your managed services model. So let's talk about median and best-in-class performance for mid-market partners, and then how do they accomplish that best-in-class? Why are we focused on mid-market partners here? If you're SMB focused, go ahead and stay on the call. The lessons are here to learn. But we're really focused on mid-market partners, and the reason for that is it's an underserved community with exploding needs. The other interesting thing about the mid-market segment is that most of the solution providers that serve it are not service-centric. Most of the solution providers that serve this marketplace are not managed service-centric. They might be project-centric, but most of them are product-centric. And most product-centric firms want to continue to sell more and more product, but what they want to do is add more pro services and add more managed services. And we're going to take a look at whether the best in class are capable of doing that. And then later in the webcast, we're going to show you specifically how they can do that with StorageCraft. But let's take a look at some brand new stats. Those of you that know us, you know we have the largest benchmark population of solution providers on the planet. And you also know that in January, we collect the Q4 2018 data. So you are amongst the first here to see the full year 2018 benchmark results. And we're also going to talk about value creation. If you go back to 2009 and you decided at that point to be an SMB managed service provider, the hottest segment, how much stock value would you have created between 2009 and 2018 versus if you go back to 2009 and you made a decision to be or become or stay a mid-market product-centric VAR, how much stock value would you have created? I'm setting you up here for some interesting news. So on the left-hand side of this chart, you can see for the SMB managed service providers what their average stats were in 2009 and 2018. So if I start on the far left, the average SMB MSP in 2009 was 2.5 million. And by 2018, they'd grown to 5.4 million in revenue. If you look at the EBITDA, the center set of bars there, the earnings before interest, taxes, depreciation, amortization. In 2009, the average SMB MSP had $131,000 in profit after the owner's fair market salary was paid to the owner. By 2018, that had grown to $503,000. That's pretty bloody good value creation, right? Super acceleration of cash flow. And if you look at their approximate stock value of the company, approximately what their company would have been worth at $2.5 million with $131,000 bottom line in 2009, it would have been worth just over $500,000. In 2018, at $5.4 million in revenue and $500,000 in bottom line profit, with the multiples of the market in 2018 worth about $4.1 million. That's 10 years worth of value creation. That's superb. I mean, that's really, really good. Driving the value of your company from $567,000 to $4.1 million is a huge value improvement. And frankly, the only way you're going to do better than that is if you buy Bitcoin at the right time, right? So the SMB managed service providers have done a great job at value creation. But let's take a look at the average mid-market VAR. These are the folks who are product-centric. Yes, they do services, they do pro services, they do managed services. It's just not the predominant part of their business. And instead of focusing on SMB customers, typically these folks focus on mid-market customers. So let's take a look at their progress over this period of time. The SMB managed service guys grew their revenue 8.1% each year for 10 years. The mid-market VARs grew their revenue, click again, Paul, 10.7% every year for 10 years. So the mid-market VARs actually grew their business faster than the SMB managed service providers. Let's take a look at EBITDA dollar production. The SMB MSPs grew their profit dollar production by 14.4% a year over each of the 10 years. There we go. The mid-market VARs grew their pile of profit dollars not by 14% every year, but by 19% every year. And if we look at approximate company value, the managed service providers grew their approximate company value 21.9% a year every year for 10 years. That is smoking hot value creation. What did the product-centric guys in the mid-market do? 24.3% compound annual growth in company value. So amazingly, although managed services is a great place to be, the empirical data says being a mid-market VAR actually was a better strategy to drive stock value. Now, I don't know anybody that's going to abandon a managed service business model unless they're really struggling. But by the same token, as you can see here, I don't know anybody that's successfully doing the product-centric business that wants to get out of it. What they do want to do is drive more services revenue, drive more project revenue, drive more managed services revenue more successfully and with less risk. And that's what we're going to talk about in the balance of this conversation. So this just in, as you can see, the mid-market VARs win the stock value creation performance sweepstakes, which is pretty darn good. So what is best-in-class performance for a mid-market VAR? Well, this is median performance. This is for mid-market VARs, this profit percentage over the last 5 years is what separates the top half of the folks in the top half of the profitability group versus the bottom half of the profitability group. So this is median profitability. Half the mid-market VARs did better, half did worse. It's a pretty thin business model, right? 2% profit, 3% profit. There's not a lot of room for mistakes. Not a lot of room for mistakes here. What is best in class? What is top quartile? Well, here you can see it's basically 4 times higher adjusted EBITDA percentage. They're running right around 10%, whereas the median folks were running right around 2.5%. It's a much more rewarding business model. Same overall business model, same mid-market VAR business model, but 1/4 of you, regardless of market, regardless of size, regardless of which vertical you pursue or whether you're a generalist or not, regardless of you're a young firm or an old firm, 1/4 of mid-market VARs perform at a profit percentage level about 4 times higher than the median. Much better ROI for the shareholders, much less risky for them. So let's talk about how they do that. Well, here's the revenue mix of the growth in revenue over the last 5 years for the median folks. Blue is the proportion of their revenue coming from product resale. Green is the proportion of their revenue coming from T&M services, project services, and managed services, those 3 different colored greens. That's for the median folks. How did the top quartile guys do? Interestingly, they grew less slowly, but look at the difference in the proportion of their revenue coming from green versus blue, coming from services, and in particular recurring services, versus blue, which is basically product resale. So the best in class, these folks are still product centric. They still have their predominant revenue stream coming from resale, but they have a much higher proportion of services, and a larger proportion of those services are recurring services. These folks don't have any interest in selling less product. Believe me, they're going to sell more product, but they grow services as fast or faster. The other thing you want to pay attention to here is that light blue segment. That light blue segment is almost invisible on the median product-centric folks. That light blue segment is cloud resale. That light blue segment is O365. That light blue segment is Azure. But that light blue segment is also backup in the cloud. It's also DR in the cloud, right? And if I was to go back one slide and look at the median folks, they barely have any light blue on their charts. Whereas the best in class folks here are clearly dramatically growing their cloud resale. And a part of that is what we're talking about today, which is backup to the cloud, DR to the cloud. As Junior mentioned, StorageCraft's got a very sophisticated and very simple solution for that for mid-market customers. So if you want to increase your cloud resale, one way to do it is to take a look at StorageCraft's ShadowSafe and OneSafe offerings. So let's take a look at the comparison between in mid-market VARs over the last 5 years between the median performers and the best-in-class performers. The best-in-class performers are not growing as aggressively. They're growing services faster than they're growing their top line. They're growing managed services about the same as the median. They have about 5 times greater proportion of their revenue coming from managed services. Their pro services are growing 8 times faster. Their share of revenue coming from pro services is about 25% bigger. Their cloud resale revenue is exploding compared to the median performing VARs. And their bottom line profit is about 4 times higher. So clearly, you want to learn lessons from the top performers in the mid-market VAR space, and that is to drive more service revenue more profitably, to drive more recurring service revenue, and specifically to explode your cloud resale growth. It's a very sticky solution that provides the customer with a long-term value. And although it doesn't require cloud resale, such as backup to the cloud and DR in the cloud that Junior mentioned, doesn't require you to change your service operations. It is a recurring service to the client. And when you sell a recurring service to the client, it gives you implied permission to come and visit them anytime. So you sell a big chunk of StorageCraft capacity in the cloud, the client uses that, you have permission to go visit them on a regular basis and talk to them about how that's going. They expect you to do that as a recurring service. And the great thing about that is when you're a mid-market VAR, the only other reason you have to call on the client is if you've got some new hardware or software to sell them. And that doesn't happen that often, and they may not want to talk to you about it. Whereas if you've got the client using StorageCraft's cloud offerings, you've got permission to check up on them whenever you want to, which is a nice way to have a sales call that benefits the client. So let's take a look at how the top performers really do this work. Let's talk about how they perform better. Those of you that know us, you know that we help you determine what we call your operational maturity level, your ability to execute a business plan the way the top performing companies do. And we give you an operational maturity level score of 1 through 5. And then on each of the aspects of, excuse me, on each of the aspects of driving your business. And we also show you the return on investment in getting more operationally mature. And so let's talk about the benefits of driving technology standards and what that means in context of our conversation with StorageCraft today. So you can take a look at this slide and you can go, well, what is my OML, that 1 to 5 scale? What's my operational maturity level on driving technology standards? If you read the text on the left and you read the text on the right, determine, roughly speaking, where you are between those two descriptions. If you're all the way over on the left, you do things more like the lower performing solution providers do, more like the people that struggle to deliver profit, that struggle to deliver service quality, that struggle to differentiate, that struggle to deliver growth. If you execute driving technology standards more like the green text on the right, you are executing technology standards more like the folks that have higher growth, higher profit, higher service quality, higher differentiation. What this means in our context today is that high operational maturity says 90% of the time that you sell backup, DR, and business continuity, it's the same vendor's solution over and over and over again. You don't represent 5 different vendors or 3 different vendors or even 2 different vendors. I know it seems counterintuitive, but the fact of the matter is the fewer solutions you have in each segment of the technology stack, the faster you will grow, the better you will differentiate, and the higher your margin will be. Let's take a look at another one quickly. Another operational maturity level trait is cross-selling. If you behave like the blue text on the left, or if you behave like the green text on the right, you can tell what your operational maturity level is. In the context of today's conversation around backup and DR and business continuity, what cross-selling means is when you pick up a new solution, you make sure that 90% of your customers buy it. That means that you get good at adopting new offerings and getting 90% of your clients to buy it, which means your revenue growth is much faster than if you less programmatically have some of your customers buy it and then also have to go out and get new customers to hit your sales goals. You get 90% of your customers to buy each offering that you offer. Your revenue growth, your account control, your gross margin, your differentiation will be much higher. So the top performers do it more like on the right. The lower performers do it more like on the left. So we took a look at what differentiates the median performing mid-market VARs from the best in class. And we said, hey, the best in class are growing PS and MS much faster than they're growing their top line. Their recurring revenue is a bigger part of their business, and they are absolutely exploding their cloud resale business, such as what Junior talked about a few moments ago. I'm going to let Janine take over from here. I'll be back to talk about leveraging mid-market business continuity to become more services-led, and then we'll take Q&A. Janine? If you are speaking, you are on mute.
Oh my gosh, I was saying such important things. I said all the secrets to life while I was on mute. So what we want to do is take a couple of minutes really quickly and just again reconnect the dots on some of the concepts that Paul shared with you, right? Is that the solution that we're bringing to the table is allowing you to have conversations with customers that demonstrate how you're able to solve their business challenges. How? By reducing costs, eliminating complexity, bringing one platform, right, to solve those challenges, scalability, feature-rich storage that's object-based, RAID-free, and then feature-rich protection, which is bringing unparalleled recovery time with a cloud-based DRaaS offering, But the interesting thing is, as you take a look to some of the things that Paul talked about OML, right, and bringing a higher level of maturity to your business and how you can drive growth and stock value, you're also able to really take some of these things and bring it back to your professional services offering, right? So, and then additionally, as you move up the services chain and bring more recurring revenue to your services with managed services, there's a couple of things here that really drive that as well. So we've done the job of saying, hey, we have a solution that helps you as a partner take advantage of the market and elevate your OML as well.
That is true. Thank you. All right, so let's talk about how to do that. Yeah, absolutely. Let's talk about how to do that. This is where I start having even more fun. All right. So here's another on-ramp to becoming services-led. Again, most VARs these days have long decided they don't want to be service-centric. They want to sell more product, and that's cool. And as you can see from the earlier part of our presentation, the mid-market VARs actually drove more stock value creation over the last 5 years than did the SMB managed service providers, who were pretty smoking hot. And the mid-market VARs were actually hotter. So let's talk about how to use backup DR business continuity, particularly in the cloud, to improve your or enhance your position with the client and your differentiation in the marketplace. So a key way to become a trusted advisor, of course, is to take responsibility from the client for something important, such as perhaps maybe their most important data. A key way to build a durable, expanding relationship with them is to get into a recurring services engagement, meaning cloud or managed services, because then you're allowed to check up on them at any time, not just when they want to buy something. And with these solutions from StorageCraft, you can accomplish both these things without having to stand up your own data center or build a managed service. Why is that? Because in addition to selling them the systems, you can also sell them big chunks of StorageCraft's cloud in various scalable ways that turn into recurring revenue and that turn into a great gross margin stream. And if I understand their program correctly, when you sell what the client experiences as a recurring service from StorageCraft, you can get all the gross margin up front. One of the biggest challenges that VARs have getting into the recurring revenue business is what used to be a big slug of gross margin up front turns into this little sort of monthly dribble of gross margin. And yeah, it's recurring, but it's not that much, and it's not what your business model is built on. So if I understand StorageCraft's programs correctly, you can sell what to the client is a recurring service and get the benefits of that relationship, but you get all the gross margin up front, which I think is a pretty thoughtful way for these guys to go. All right, we looked at this before, so let's take a look at an ROI analysis for getting into a partnership with StorageCraft. So what we did is we had StorageCraft take us through basically what it costs to become a StorageCraft partner at various levels, whether you're certified or elite or what have you. What does it actually cost me as a partner to get into business with StorageCraft? And how many StorageCraft solutions of what type would I need to sell to which customers in order to make that ROI work, in order to make it sensible to join into the partnership? That I could sell enough StorageCraft to break even on my partnership investment and then make a good return on investment in a meaningfully short time frame, right? So let's check it out. So here are the different cost components that we put together after we talked with the nice StorageCraft folks about what it took to be a partner. There's the opportunity cost of training, right? I got to train my sales reps. I got to train my service people. I got to do the certification thing, and that's good because I need the knowledge, but it's painful because I got to send people away to training, and while they're at training, they're not billing, and oh my God. And then I've got the direct cost of the training, which is the expenses and whatever I have to pay for the courses and all that kind of stuff. And I got the not for resale equipment that I got to buy in order to basically train my people and have a lab and all that kind of stuff and have demo capability and so on. So I got my total investment in StorageCraft. And then I've got to sort of mathematically calculate that out based on, am I trying to be an elite, a premier, or a certified? And you can see the criteria as I understand them on the right-hand side, right? So elite says, hey, one master engineer, one certified engineer, that training needs to take place. And then I somehow got to train about 15 of my reps. Now, StorageCraft doesn't require you to train 15 reps. I just put that in there because the average mid-market VAR has 15 reps. Based on our benchmarking, we know that. The average mid-market VAR has 15 reps. Why do you want to train all 15 of them on StorageCraft? Because in order to get an ROI, this has got to work. You've got to sell a certain number of them, and we got to stack the odds in our favor. And we all know that not all 15 of our sales reps are going to fire off and do something with a new solution. So we got to play the odds. We got to train all of them. If that training cost is reasonable enough and the time invested is reasonable enough that we can get a realistic ROI in a usably, meaningfully short time frame. So you do all of this math, and what it comes out to is, to become elite, it's about $76,000. To become premier, this is hard and soft cost together, it's about $70,000. To be certified, it's about $61,000. Fantastic. Why would I do that? Well, because you'd get a return on investment on it. So I did the math for you. Let's take a look, right? How many, mid-market OneSafe deals would I have to sell to break even on this? And how many would I have to sell to get a good ROI? Well, let's find out. And bear with me on the spreadsheet. I did the math so that you don't have to. So you can see from top to bottom, I'm looking at small deals and big deals. I've got the whole thing lined out in small deal and big deal, retail, COGS, street price, gross margin, et cetera, et cetera. Then from left to right in the yellow columns, what am I selling in each of those sales that is coming from StorageCraft? Non-recurring product and recurring service. What is it that I, the partner, am doing, those blue columns, in terms of non-recurring project revenue and recurring managed service revenue? If I do the managed services around that data protection stack. And then I say, well, okay, what if I just sell 1-year term deals versus 3-year term deals versus 5-year term deals? Because obviously the higher OML managed service people don't sell 1-year contracts, they sell 3 or 5. And rather cleverly, StorageCraft will sell you chunks of their cloud to sell to the client, either in 1-year chunks, 3-year chunks, or 5-year chunks. Rather clever of them. So here you can see the gross margin at the bottom right that's going to accrue to you for each deal that you sell that's a small deal or a large deal, if it's sold in a 1-year term, a 3-year term, or a 5-year term. So if I just look across the bottom row and go over to the right, if I sell a 5-year big deal as defined here, and that's a bigger mid-market deal, it's not an enterprise level deal, it's just bigger mid-market. If I sell that deal, I get $78,222 gross margin dollars. Well, a minute ago, I told you to become an elite partner, you end up investing about $71,000, $72,000, $73,000. If you just sell one of the bigger mid-market deals with 5 years worth of storage on it, you get $78,000 worth of gross margin. You're done breaking even. If you go up one row and jog over to the 1-year term, the green column called 1-year term, and look at the small deals, you can see 20,000 gross margin dollars. So if I sell one small mid-market deal with a 1-year term worth of storage, cloud storage on it, I get about 20,000 gross margin dollars at street price. Fantastic. That would tell you that if my investment was $71,000 to get into the partnership, I got to sell about 3.5 of these small deals in the next 12 to 18 months to make it worthwhile, right? So let's take a look at how this breaks out. Excuse me. I get to break even if I sell 3 small deals, if I'm certified and I sell 3 small deals for 1 year, 1.93-year term deals or 1.35-year term deals, or if I sell 1.9 1-year big deals, 1.1 3-year big deals, or just less than 1 5-year big deal. And then you can see the return on investment. And the way I calculated this return on investment at the bottom is I said, okay, I'm going to train 15 reps. And in the first year, only 5 of them are going to sell a deal. And I sort of shook out the deals in terms of how many big and small deals. I just sort of evenly distributed it. So I trained 15 reps. I spend the money and the time and the opportunity cost to train my engineers, a couple engineers. I get certified, right? And all I got to do is get 1/3 of my reps to sell 1 deal each, and I get a return on investment of somewhere between 160% on my investment and 535% on my investment. This is for the certified level of partnership. If I go to the elite level of partnership, the numbers change a little bit, but as you know, I get a better deal on the equipment, and as you know, I get more differentiation in the marketplace. I have higher credibility in the client's eyes. I'm more rare. I have the ability to demonstrate value more successfully. So this is just getting 1/3 of your reps to sell a deal in the first year. And it could be a small 1-year deal, or it could be a big 5-year deal. It's a pretty good deal, right? And so this summarizes sort of the low case. If I go for certified with StorageCraft in 2019, I sell 3.1 1-year deals to smaller clients. I'll break even, just 3.1 deals. And if I can get 1/3 of my 15 reps to sell 1, I'll add 100,000 gross margin to the bottom line after having paid for the training and the startup. High case, if I go for elite, even though it costs more, and I sell 1 5-year deal to a bigger mid-market customer, I'll break even. And if I can get 1/3 of my reps to each sell 1, I'll add 391,000 gross margin dollars after the startup cost in 2019. So now you know the number of them you need to do to break even, and you know the number of them you need to do in order to generate a pretty sharp ROI. So I like ROI statements because it helps me understand how to drive my business. And the blue columns here tell you you're selling more project revenue and you're selling more managed service revenue. And because you're selling StorageCraft's cloud, you're driving up your cloud resale revenue, which is what the top performers are doing. All 3 of those things is what they're doing. And I just showed you how to do it with StorageCraft. All right, Janine, you are up. Questions for you, me, and Junior?
Yeah, we just wanted to quickly talk about our program. We also, am I still on mute? I'm not, good. What we wanted to do when we brought this solution to the market was we wanted to refresh the program to reflect the addition of this higher end storage plus converged offering to the mid-market customers. So we updated our channel program. You can go to the next slide, Paul. And we increased the benefits incentives around this particular solution, as well as keeping our core benefits around our managed service product, right, intact as well. So great spiff opportunities, right? Great deal reg discount. We also added a quarterly rebate, right? So some of those numbers that Paul showed, as you move up this chain, you also have the opportunity to get more money back quarterly based on how much you're selling. So helping you to be rewarded for standardization, as Paul talked about, in cross-sell, upsell. So it's super excited about that. We really want to bring our partners the benefits, incentives that make the most sense for adopting this program and reward you in your bottom line pocket as well as your sales reps.
Yeah, and I would just underscore your comment. The ROI model that I just showed you folks doesn't include these additional incentives because I couldn't figure them out, which means I'm not as smart as a mid-market VAR. I couldn't figure out how to model them. But this is all in addition to the ROI that I showed you on the previous slides.
So what we'd like to do is we have a couple of minutes We want to be cognizant of your time. We'll stay past the hour as long as we have questions, but we wanted to give you the opportunity to present some question and answer to both Junior and Paul. So all you have to do is type them in that question and answer panel. We do have a couple here that I can start with as you guys, first and foremost, yes, we are going to send this recording out. That's going to come from Paul's team after the broadcast. We'll make sure that you have it available. Additionally, here's a question actually for Paul. Paul, there's a question for you. Are you ready? The question is
yes.
Regarding, let me see if I can make sure I get it, I ask it right. Hey, I get that the best in class dictate what products the customer should buy. That's not always possible with larger clients. So I guess the best in class must focus on smaller clients. Is that correct? Is that a correct assumption?
That would be an incorrect assumption. And so let's just back up real quickly to the people that have been doing managed services the longest, which is the enterprise guys, and they've been doing it since basically the early 50s when IBM invented the business model. Regardless of the size of the client, big or small, there's no way you can be successful in pro services and managed services if you attempt to implement and support the massive array of stuff that's out there. The only way you can be successful is if you radically narrow your choice of technologies to one technology per segment of the technology stack. The enterprise managed service providers have been doing that successfully since the 50s. The mid-market managed services game started in the early, 90s, late 80s. They've been doing it successfully in the mid-market for that length of time. You just have to say, dear customer, if you want to get the business benefits that you're looking for, and if you want a successful implementation, and if you want to transfer the risk of managed services or IT operations to us, any one of those three things you want to do, dear customer, this is the product that you should have. And stick by the business benefits to the customer. If you want it to function the way you want it to function, it's this product. If you want a flawless install from us, it's this product. If you want awesome managed services from us, this is the product. And the customers that will pay a win-win price for an IT relationship will respond to that. That's why the top performers do it.
A question, I think this is it's actually for me, but I think Junior's going to help me answer it. There's actually two questions on our cloud, right? The difference between our storage craft cloud and the public cloud, but there's a specific question on Microsoft Azure, Junior, and if we can't get to this answer, we can always respond if I chat with Bill afterwards. But we did talk about this. This particular person was at a breakout at Evolve about the difference between utilizing our cloud specifically with utilizing Azure. And I don't know, Junior, if you feel comfortable speaking to that or not.
Yeah. The biggest thing what we find when someone wants to build a DR as a service offering in the public cloud is you're going to have to spend a lot of money in consulting and trying to come up with a solution. And it won't be quite as functional or as easy to use. A lot of moving parts. So think of it kind of like the public cloud when you're trying to build an offering on top. It's kind of like a Home Depot, right? You walk in like, hey, this is how you can build a house. Here it is, and you have all those the parts, the building, the materials, all that. But with StorageCraft, we've built already that purpose-built cloud. It's specifically for DR as a service. You have things that you don't that are included. You have static IPs included. You have affordable C driving. Bare metal restore drives coming back. There's one-click failover, automated policies that automatically fail over, complete access to the networking layer. A lot of layers that you're not going to get access to in the public cloud, but we expose those so that you can connect to whatever firewall the client has, and you can have a secure connection back to your on-site. So that's kind of the difference. when you actually start adding up the costs, I mean, as soon as a machine starts spinning up in Azure or AWS, it's going to start racking up the bill. With StorageCraft, you can run the machine for 30 days without any additional cost in our cloud. So you can, every month, we've pushed a lot of best practices. You can fail over, test all your clients. You can make that an offering for your managed service, that you do a monthly test. And for it's really easy. One click, you test, 100 machines and you can charge that to your clients. But you have that ability, and you don't get charged from us 30 days at all. So you can do every month. You can do the test on those machines.
So, to underscore Junior's comments, I spent the last 2 days, yesterday and the day before, in a group of mid to upper mid-market VARs. They ranged in revenue from about 30 million to about 200 million. And we had 12 hours together, 12 structured hours. And I will tell you, half an hour, which is a big chunk for an ad hoc topic, half an hour was spent on talking about how in the world you figure out what you've sold the client in Azure, how to get it to work, and what it's going to cost, and all that kind of stuff. It's enormously capable, but I think Junior's analogy to Home Depot is right. It's very clearly a set of power tools in a box, and your guys have to figure out how to do all this stuff. And forgive me for being a little bit jaundiced, but there's a lot of engineers that love toolboxes and screw around with stuff, and that's great, but that's not the business. The business is efficiently and effectively providing great solutions to the client that you can make money on. And so I really like his analogy, because what StorageCraft has done is turn it into a solution. Right, the house is built, which is great.
Okay, a couple things before we get to the other couple questions, because we only have a couple more minutes. What we want to make sure you guys understand is working with us allows us to really grow together, right? Let's win some business. So if you're looking at opportunities in the future and want to understand if you can adopt the solution, ask yourself and your partners, your customers, this question: do you have projects planned? Is it becoming challenging, Mr. End User, to manage data silos? Where are you in the life cycle of your data management solution, Mr. Customer? And what will happen is when you identify those questions, we're going to help you do the heavy lifting. We're going to joint sell, and we're going to expedite winning that deal. So we do have a part 2 to this, where we're going to get into some details on some really cool stuff, much more action-oriented. You are absolutely already registered for that, but if for some reason you didn't, you missed that registration piece for that second part, we have created a quick little link for you to do so. It's a bit.ly link, bit.ly/STC part 2. And if you want some information before that, if you could go back to the other slide, Paul, you have the opportunity to get us on the phone and do a deep dive by going to a very quick landing page we created called storagecraft.com/midmarketop. If you don't want to wait till March 29th to see the part 2. A couple more questions if you guys want to hang out. If you don't, we understand. We want to be very, respectful of your hour. Paul, this one is for Paul. Can you help me better understand the 100% cross-sell rule? I think that's what you can't really mean every customer buys everything I offer. Can you?
Yes, I can. So if you look at top performing solution providers, including mid-market VARs, there, as you no doubt would guess, there's a number of common characteristics you see in all the top performers. And one of them is they're very good at looking at each customer as an asset, meaning because I target a certain profile of customers, whatever profile you target, the odds are pretty good that you're assembling a set of solutions that appeal to customers that look like that target. The odds are pretty good the customers that look like that target already have budget for everything that you do. That's why you came up with what you did. They already have budget for everything that you do. And they're already spending it somewhere, either with you or with somebody else, or in the case of some pro services and even managed services, they're spending that money internally, which means the way to optimize the customer relationship, the way to give them the most value and you the most revenue and account control, is to make relentlessly sure that every customer buys every single thing that you do. And if you look at the top performers, they're very successful at it. They didn't learn it overnight. They started like everybody else, but they set as a goal and put into the incentives for their account managers or their farmers or what have you to make sure these customers buy every single thing that we do. And every increment you can make progress on that, you will find your revenue goes up faster because you don't just have to add new accounts to grow revenue. Your account control improves, which means you have less threat from the outside and more margin, usually more margin percent. And you're delivering more value to the customer. You're harder to throw out. So this is what you want to accomplish. And in fact, it's what you see time and again in the top performers, regardless of customer size.
Awesome. We're going to take one last question. Here's a good one for Junior. When you talked about the comparison to Rubrik or Cohesity, what's the comparison of your solution, which I believe they mean OneSafe, to the Rubrik or Cohesity architecture? Junior, are you there?
Yeah.
Oh,
so
hi.
one of the biggest, how does it compare architecturally? It's the same. It's a scale out architecture. So all you need to do is just put in another node, and your capacity grows, right? With the object store. So really similar in effect that you could just drop in another node, and everything just grows from there. The biggest difference from some other competitors that you have to do forklift upgrades. You run out of space in an appliance, you're going to have to buy the next model up appliance, or we don't have to deal with any of that. All of the complexity of that goes away. The complexity of trying to guess how much they're going to need in the next 3 years so they can get ROI, that goes all away, because if you just need a little bit more, you can just keep growing a little bit more at a time. So it makes it a lot easier. It takes away, you don't have to have a crystal ball to try to figure out how much you're going to need. So, and have a hard conversation in a year and a half because you didn't nail the capacity planning calculation. That was this huge formula that never gets it right. I mean, every time I meet with partners, I ask, is like, well, how many of you, nailed your last, your last capacity plans for a customer? And it's never, it's just impossible. Data's exponentially growing. So we take away you don't have to try to do guesswork. You can just provide a solution.
Awesome. Thanks, Junior. You guys, we have had a great time today with you. Thank you so much for taking time out. Paul Dipple, always such a pleasure to collaborate and share insight with you. Thank you so much for working with us on this.
Likewise.
Don't forget, guys, don't forget about part 2. We're going to send you a reminder, and we hope that you enjoyed the time that we spent together and took away some great points of interest. And we will see you virtually on the 29th. Have a great day, guys. Take care.
Thank you.